Hey everyone! Welcome back to Absolute Finance Key, your go-to channel for corporate finance, investment insights, and financial knowledge. Today, we're diving deep into the top 5 theories that underpin everything from stock market movements to investment strategies. These theories are the fundamental building blocks that help us understand how financial markets operate and how investors make decisions. Whether you're just starting your finance journey or looking to solidify your understanding, this video will break down these complex concepts into bite-sized pieces. So buckle up because we're about to demystify the world of finance, one theory at a time. Let's dive in. First up, we have modern portfolio theory, or MPT for short. Developed by Harry Markowitz in 1952, this theory revolutionized investing by emphasizing diversification. Imagine you have $1,000 to invest. Would you put it all into one stock? Probably not. If that one stock tanks, you lose big time. MPT says you should spread your investments across different asset classes, stocks, bonds, real estate, to maximize returns while minimizing risk. The key idea here is the efficient frontier, a curve showing the best possible return for any given level of risk. The goal? To find that sweet spot on the curve that aligns with your personal risk tolerance and helps you build an optimal portfolio. Diversifying your portfolio helps you weather market storms and achieve more consistent returns over the long haul. Next up, we have the Capital Asset Pricing Model, or CAPM, developed by William Sharpe in 1964. This theory builds on MPT by giving investors a way to calculate the expected return of an asset based on its risk compared to the overall market. The CAPM formula, ERI, =R_F plus beta asterisk, ERM, R_F. Simply put, CAPM tells us that the higher the risk, beta, the higher the expected return investors will demand for taking on that risk. If a stock is riskier than the overall market, investors will only invest if they believe they'll be compensated with higher potential returns. CAPM helps us quantify this risk-reward relationship and make more informed investment decisions. Now let's talk about the efficient market hypothesis, or EMH, developed by Eugene Fama in 1970. This theory claims that stock prices already reflect all available information, making it nearly impossible to consistently beat the market. Think of the stock market as a giant information processing machine. Every news article, earnings report, and CEO tweet is factored into stock prices. EMH argues that by the time you hear about news, the market has already adjusted prices to reflect that information. There are 3 forms of EMH: weak, semi-strong, and strong, each with varying degrees of market efficiency. While consistently outperforming the market is incredibly difficult, EMH serves as a reminder that trying to outsmart the market is risky. Instead, focus on building a well-diversified portfolio that aligns with your long-term financial goals. While CAPM focuses on a single risk factor, Arbitrage Pricing Theory, or APT, developed by Stephen Ross in 1976, acknowledges that multiple factors can influence asset prices. The global economy is a complex system with countless moving parts like GDP growth, inflation, and interest rates. APT allows investors to identify and quantify these various risk factors and assess how they might affect their investments. For example, if you believe GDP growth will accelerate, you might expect certain sectors to benefit. APT allows you to create a more tailored investment strategy by considering a wider range of economic and market variables. Think of APT like baking a cake. Different ingredients, economic factors in different proportions can affect the final outcome, your portfolio's performance. Last but not least, we have behavioral finance, a field that challenges the traditional assumptions of rationality in financial decision-making. Developed by minds like Richard Thaler and Daniel Kahneman, behavioral finance acknowledges that we're not always rational investors. We might hold on to losing stocks for too long, loss aversion, or jump on a hot stock tip without research, hurting. Behavioral finance helps us understand these psychological pitfalls and how they can affect our investment outcomes. By recognizing our own biases, we can try to mitigate their impact and make more rational decisions. Understanding these behavioral patterns helps us control our emotional responses and make more disciplined investment choices. And that's a wrap on our whirlwind tour of 5 essential finance theories. We've covered a lot of ground today, from diversification and risk-reward relationships to market efficiency and human behavior. Quick recap: MPT, diversify your portfolio; CAPM, more risk, more reward; EMH, markets reflect all info; APT, multiple risk factors matter; behavioral finance, people are irrational. Don't forget to like, subscribe, and hit the notification bell for more finance insights. See you in the next one.